Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. Now in today's episode, we take a look at investing offshore and the opportunities that are available. But of course, before you take your money abroad, there's some critical questions to ask. Which particular sectors, which particular equity markets, and of course, just how much exposure for you to balance out your portfolio. To help us answer many of these themes, I'm joined in studio by Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Byron, Portfolio Manager at Vestact. Gentlemen, always good to have you with us, and thank you for making time. I'm actually excited by the theme when we talk about offshore stocks and offshore exposure, because it's really come up as a significant theme throughout the series of Portfolio Watch. But when we think offshore, there's usually a bias to actually think US equities. But there's a bigger market out there, right, Andrew, which actually substantiates our investment case to look abroad.
Yeah, I suppose there's a much bigger market out there than just the US. You know, when you think about South African investors, typically, most of our assets sit in South Africa. When you think of your house, for instance,
your
retirement, absolutely. So we believe that you should, as a South African investor, you should be looking abroad. If you think about South Africa and how much it constitutes of the world market, if you can look from an economic point of view, I think it's about 0.6% of global GDP. From equity markets, very, very similar, yet most of our assets sit in South Africa. So we believe that investors should be investing offshore. This isn't necessarily because of a negative view towards South Africa. There is an element of fatigue in South African equities, given what's happened over the last 5 years. In real terms, we've spoken about this, we've gone nowhere. But that aside, we should be looking to invest offshore because there are just far more opportunities out there. The US you mentioned, is obviously a case in point. When you look at the equity market, I think the global equity market, including emerging markets, I think 40% is made up of the US market alone, which is typically overweight the US. So whilst South Africans are underweight the world, when you invest offshore, you typically go overweight the US. The US only makes up about 24% of global GDP. So equity markets are very much, dominated to the north and to the west. Whereas your growth drivers of the world, if you believe the mantra that economic growth drives corporate profits, which drives investment returns, we see an economic center of the world moving towards the south and towards the east. It's obviously India, China, Southeast Asia, etc. And the world typically is very underweight those areas when it comes to equity markets. So it's not just about going offshore, because if you blindly go offshore and buy a ETF tracker, for instance, you're going to be very overweight the US.
Yeah.
There's great opportunities in emerging markets and in the east as well. So it's not just US or developed markets. We need to take emerging markets into account as well.
Yeah. How often should we actually be reviewing this theme, Byron, as to when we talk about getting offshore exposure, as to identifying specific markets where there's key growth coming out of those particular regions, especially if we take the currency into consideration, because that's often an indicator for some domestic investors that, oh well, the rand's blown out, let me take my money offshore. But it's all about timing it correctly too, right?
Well, the beauty of investing in equities is that the smart CEOs of these companies make those decisions for you. You've got a company like Amazon, for example, they've seen an opportunity in India. Yes, your money is sitting in the US in US dollars, but they're taking a portion of that money and they're going and investing in a country with 1.2 billion people, horrendous traffic, and probably dying for online retail.
Yeah.
So you don't necessarily have to make those big decisions on which regions to invest in. If you pick the right stocks, and the right management teams, they're the ones that are going to go around and eye out those opportunities.
Mm-hmm. So picking the right stocks and of course seeing those opportunities come through. I do want to get your view as well on the currency very briefly, because also that's a major influence as to how your offshore exposure might actually perform. But should we actually be should this be keeping us up at night, in other words?
Of course it is a huge factor. I mean, there's a lot of potential clients who are sitting on rands waiting for the rand dollar to come back to 12. I do think that the rand is oversold and we are on the cusp of a turnaround. Having said that, I agree 100% with Andrew. You do need to have offshore investments, and if you don't already, you can't be too precious with the currency. You've got to look at the asset prices on the other side as well, and average it in. Send a bit now, send a bit later. You're getting average prices on the other side, and you're averaging your currency. And people also, historically investing offshore was a bit taboo, and people also think it's extremely difficult. It's not. It's quick and easy. I mean, buying a property offshore, that's a completely different situation. Imagine dealing with conveyances overseas and tenants and burst geysers. But investing in equities offshore, you can be done within a week and have your entire portfolio setup.
Yeah. Let's talk about that exposure here, Andrew. Just how easy is it to take our money offshore?
Before we get there, just on the currency issue, Byron
Yeah.
touches, I think, on a very important point as well. Trying to time the currency is, it's a guessing game. You can put a frog in the middle of this table and try and guess which way it's going to jump. You've got just as much chance in the short term of getting the currency right. But if you actually look at the correlation between the rand and US or global equity markets, actually highly correlated. And it makes perfect sense from a risk-off point of view. When there's risk-off, what happens? Emerging market currencies get sold. South Africa is the proxy, or the rand is the proxy for emerging market currencies, given it's the most liquid currency in the world. So when you've got a sell-off or risk-off, we see a weaker rand. At the same time, we see weaker growth assets around the world. So whilst you might be taking your money offshore when the rand is weak, you might also be buying offshore assets that are relatively cheap. And obviously the converse, or the inverse rather, applies.
Sure.
When the rand is strong, you might be buying expensive assets offshore. So there is, it doesn't hold perfectly, but there is an element of correlation. So we believe that now is as good a time as any time to be taking your money offshore to invest in growth assets.
Sure.
Offshore, yeah.
Even with around like 1450 odd levels, 1430, especially following last week's activities.
You know what, you're never going to get it spot on.
Yeah.
And when you take your money offshore, you mustn't think in rand terms. You must think in, whatever currency you go into, US dollars, for instance. You must be looking at US dollars. Don't look at your rand returns, because very often you think you're doing very well. There's a massive currency impact in there. You need to take your money offshore and think of it as global assets in US dollar sense.
So let's talk about the exposure. Just how easy is it? Byron said it's fairly simple. Is that the case?
So there's a number of ways you can do it. Yes, it is very simple. You can obviously take your money offshore, using your offshore allowance. People think that
That's
there's restrictions.
Rand, isn't it?
People think there's restrictions. 10 million rand. There's not a hell of a lot of people out there that have 10 million rand of cash lying around that they can take offshore. So we don't really see it as any restriction. You can take almost as much money as you want to offshore. You've obviously got your travel allowance as well. There's an additional million rand. Or I think it might even be 2 million rand right now. So you've got that allowance. You can do an asset swap, that there's no real restriction. So you can use a company's balance sheet, Old Mutual for instance. You can use us as an asset swap. You can use our balance sheet offshore. The issue with it is that when you take that money out, when you disinvest, unfortunately that money has to come back to South Africa. You take it out in rands. So it's not offshore forever. And you can also invest into a locally listed feeder fund, or an exchange traded note, which I suppose we'll chat to later, which are listed on the JSE, and get offshore exposure that way.
Sure. And when we talk about fees, is it quite substantial, or depends again on the kind of option that you go for?
Absolutely, yeah. Again, it's completely up to you. If you want to go for an ETF type solution, your fees are obviously minimal, specifically when you're looking at the global, these large vanguards, for instance. Your fees are essentially zero. We're on this road to lower fees. But there's obviously more expensive options as well. It's completely up to you.
Yeah. Well, let's take a look at some of those options using ETNs or going direct and adding particular stocks to your portfolio by taking a look at some stocks listed offshore that you might be able to add to your portfolio. Let's touch on some stocks now. And Byron, I'd like to start off with you because as a representative of Vestact, I know that you've been very bullish on offshore exposure as well as exposure to many of the technology stocks there. Let's touch on to one of those popular ones, Apple, right? It's been a significant leader when it comes to the tech space, and of course that $1 trillion cap, that they surpassed earlier this year. But what supports the investment fundamentals of Apple?
So a lot of people still think that these tech stocks are these high beta, high risk, high reward type businesses. But the Apples and the Googles and even the Facebooks have become, what GE was 20, 30 years ago. These are very, very profitable businesses with pretty decent fundamentals. Apple trades at 20 odd times earnings. They're sitting on $200 billion in cash, which is 20% of their market cap. And they're showing decent growth. So, you're not investing in smoke and mirrors here. This is, of course, the biggest business in the world. A lot of focus has been on iPhone sales, which is, of course, the core part of their business. But more and more, that services business is becoming very significant. They've got over 1 billion devices on their network. Those are people that are buying music, buying iCloud storage, buying applications. Every time you purchase anything on an app through the iStore, Apple take a cut. So the more people they have within that network, that services business becomes more and more significant. I mean, for example, the music. So you set up years and years of playlists. If you ever unsubscribe, you lose that. The iCloud storage is massive.
Yeah.
You know, I've just had a baby. I've got thousands of videos that I'm storing. You can't delete those. So we've upgraded to like the 2 terabytes of iCloud storage because, you know, you don't want to lose your pictures, and the storage is such a headache. But if you do it on the iCloud and you're on the Apple system, you're going to pay them a monthly fee for that storage, and people aren't going to close that. That's going to carry on. So the more people they can get buying iPhones and get into the Apple network, the better that annuity type business will be. So obviously the phones and so on have become a bit utility like, and everyone's pretty similar now in terms of quality. You know, Samsung, we've got big Chinese players coming in.
Sure.
But it's that network that's very important.
And given the valuation of this particular stock, if you compare it with the likes of Google or Alphabet as it's referred to on the exchange, how do you see the dynamics performing, given that Google as well is focused on services and not necessarily just pushing the search engine element of it anymore?
The underlying fundamentals are actually pretty similar. Google's also trading, they had their numbers out last week at 20 times forward earnings. They've got $100 billion in cash. So they're not expensive stocks in this environment where you've got interest rates at 3%. But Google, a very similar story. You know, this is obviously an advertising business. That's still the core of their business. But they are the internet. You know, everything is done through Google. And then you forget that they own YouTube, which is also absolutely massive. So that advertising world that they've been able to create is phenomenal. And they've also got a very big investment arm where they're using a lot of that money to look for new avenues of growth. So again, this is another way to access a global business. I know we were talking earlier about investing in the US. I'm pretty biased towards investing in the US because I think it's the most business-friendly place to invest and most very supportive of innovation, yet the business you invest in are global. Apple gets 60% of its earnings from outside the US. I'm not 100% on Google, but I mean, Google doesn't have to actually go into a country and put huge capital costs to set up there. You know, people just need to access just have to have access to the internet, and they're a Google customer.
Yeah, makes a lot of sense. Before we go to ad break though, Andrew, your thoughts on Apple and Google? Are these two stocks that Old Mutual is keen on?
So Apple, we don't hold at the moment. I think it's a fantastic business, and Byron touches on it. The client loyalty, I think, is what stands out for me. Switching costs are very, very tricky or difficult as a client, as Byron explained. So I think that for me is a standout point when you think about Apple. You know, they obviously develop operating systems as well as the hardware, and that's different to what Google does or Samsung. You know, Samsung is the market leader in smartphones, but they are using, you know, it's not their software that they're using. So Apple needs to, I suppose, innovate and stay ahead of the game, or stay on top of their game at least when it comes to, you know, both the operating system and the hardware. Whereas Google, for instance, you know, their operating system is going to be used on smartphones, and it's not just reliant on a single smartphone. So like you've seen a Nokia in the past, you know, fall over as they've fallen behind. You know, Google doesn't really face that risk, because if Samsung falls over, you know, it will be Huawei or, you know, whoever the next one is that uses their operating system on their phones. But Google, we really like. We do own Google. Obviously, the ad spend is the big cash cow, and then that allows it to spend or invest on what they call their other bets, you know, the alphabet parts of their name. And this is autonomous driving, we've spoken about before, the artificial intelligence units. I forget the name, just escapes me right now, but you know, they generate a huge amount of cash from that ad revenue, and I think that gives you a sense, or gives you a optionality almost on those other bets that they're investing quite heavily in. So yes, we do like.
And the Google Cloud is also very exciting. And the irony is that Apple actually used Google Cloud for their cloud storage.
Wow.
So if you're paying Apple for your iCloud storage, the underlying service provider is Google. So they do, and I know Google also pay Apple billions of dollars every year to have Google as the first search engine, you know, when you search on Safari. So there's lots of linkage there, and they're customers of each other in many ways.
Very smart, and of course keeps us as well in the loop as consumers. But we'll continue giving you insight into some more stocks, especially those within the technology space, the likes of Visa. We'll also take a look at Bitcorp and some exchange-traded notes for you to bear in mind. We'll be back right after this short ad break, but keep your emails coming to portfoliowatch@abn360.com and keep tweeting us at CNBC Africa using the hashtag PortfolioWatch. Welcome back. You're still watching Portfolio Watch, where our focus on the show today is how best to actually seek offshore exposure, especially given that the South African market is minuscule compared to our global peers. In studio, I'm still joined by my two guests, Andrew Dittberner, who's the Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Byron Lotter, Portfolio Manager at Vestact. Now, just before the break, we touched on stocks like Apple as well as Google, the famous technology stocks that often get quite a bit of attention. But earlier on, we did mention that there's a more passive way of getting exposure to global equities. And I'd like us to start off with an ETF and then move on to an exchange-traded note. But the iShares Nasdaq Biotech, and I understand this is also a feature where many of the companies we touched on before the ad break also have a particular link into this. And what are the fundamentals here?
So when you think of technology, we were talking in the break, you immediately think of these tech companies. But biotech is technology based in biology. And this is the use of living systems, living organisms to produce products or technologies that improve our lives, improve the health of the planet, etc. And it's been going for a very, very long time, but biotech more recently over the last couple of years has become more well known or well spoken about. But you can go back to mold, the penicillin, that was founded in the early 1900s. We can think about food, bread, yeast, fermentation, alcohol. That's, a very important process within biotechnology to produce alcohol. But now it's becoming, more and more prevalent in the prevention of disease rather than the cure of disease. So when you think of pharmaceutical businesses, they're using chemicals, to produce medication to cure diseases. Biotech is using biology to prevent, and you can think of genome or genetic modification, identifying cells that might be cancerous in the future and curing it today in order to prevent someone from getting cancer, down the line. So biotech's a massive industry at the moment. There's a huge amount of companies that are working in this space. There's a lot of risk. There's obviously, long lead times in bringing products to the market, etc. So as a result, instead of trying to pick a single winner, we've decided to get exposure to this theme through the biotech ETF, which is obviously a low-cost tracker.
What kind of stocks are incorporated?
So there's obviously your large cap, well-known, your Amgen, Biogen, Gilead's. There's a company, Illumina, which I think Byron is familiar with, which produces hardware in genomes for genome sequencing, etc. So there's a lot of well-known companies, and then there's a long list of very small companies, or long tail, I suppose, in this ETF of small companies, and one of them might be a massive winner in the future, and then that would obviously sit up. But the top 10 companies in the ETF probably make up about 55% of that ETF, which I think gives you a fairly decent diversification to these biotech companies.
Yeah. That's not the only passive option that you've got for us on the list today, but Old Mutual also has Old Mutual Wealth specifically has a global equity exchange traded note. Key stocks as well that feature over there?
Yeah, so this is a recent listing. It's quite exciting for us. So it's essentially listing our global equity portfolio. It trades almost as a stock on the JSE, so you can go and buy it on the JSE, and it gives you exposure to our global equity portfolio. At the moment, that's constitutes about 22 odd stocks, a fairly highly concentrated portfolio, developed markets, predominantly the US. As Byron said earlier, we try and identify companies, talking about emerging markets and having exposure to emerging markets doesn't mean you have to go and invest in China. I think if you're investing directly into emerging markets, you need to be on the ground, really understand what's going on in those environments. But you can get exposure through companies of the likes of your Amazons, your Googles, Nike, Starbucks, etc., that all have a very strong emerging market growth theme. So this is quite an exciting product that we've recently launched.
A new product and exciting, but I do want to get your views, Byron, as to how do you find the balance between either going directly into those particular shares or using the passive option? What have your clients actually given you feedback on? Do they prefer the full report and breakdown on Nike, or the more passive route is actually more favorable for them?
Well, as you know, I'm a stocks guy, so I prefer going direct to equity. Having said that, in the biotech space, as Andrew was saying, some of the results can be binary, whether these companies get an FDA approval or not. So it's very risky. I mean, you need a PhD in chemistry to understand a lot of what's going on in that sector. But there's no doubt that the sector in general is extremely exciting and there's huge growth potential. So there's a lot of merit into buying an ETF and getting exposure to the whole sector. We specifically like Amgen and Illumina. Amgen itself is so big, it's $100 billion, it could be considered an ETF in its own right.
Sure.
And we really like the model behind Illumina and what they do, their first mover advantage in genetic sequencing. And as for the ETN, it's expensive to get money offshore. The banks will charge minimum fees, and not everyone has that amount of money to get started with, and also to instantly diversify. So an ETN like that listed on the JSE certainly allows a lot of people who wouldn't necessarily be able to go offshore through a direct service provider to have immediate access to that old mutual fund. So there certainly is merit behind both of those passive investments.
I like the feedback that you've given us, even though that you're a stocks guy, but quite right, more options certainly available. And what about S&P Global? Before we actually come on to another stock that Byron's been keen on, that we've got on our list.
So S&P, obviously a very well-known company. When you think of S&P, you immediately think of the S&P 500 or the credit ratings guys, because they also, do the ratings that we very
Not
often
our
speak about.
Right now in South Africa, right?
Exactly. So they've got a couple of, different business divisions. Obviously the ratings, and they didn't shower themselves in glory in the 2008, 2009 global financial crisis, not just S&P, Moody's, Fitch, etc. I think Lehman had an A rating a week before it went bust. But many people think that's actually weakened their position. We believe otherwise, given that the amount of money that is now spent on compliance and the improvements that have taken place since then, I think it's actually made the barriers to entry, a lot higher than what they previously were. If you're looking to issue debt as a company, you need to have some sort of credit ratings, agency given a rating on your debt. And who else do you go to besides, the well-known, Andrew and Byron credit rating agency doesn't hold a lot of weight. You got to the big guys, you got to S&P, you got to Moody's, etc.
Sure.
Then they've obviously got their market data, they sell market data to financial services firms like ourselves, your Bloombergs, your Reuters, etc. And then they've obviously got their benchmark or indices division. And this talks to, I suppose, the theme of going passive ETFs. We've seen an absolute explosion of the amount of ETFs, and they have to track some sort of benchmark, and typically they're tracking an S&P type benchmark, whether it's S&P 500 or some other. So there's a number of different, I suppose, divisions to this business. Not a drip in rose from a valuation point of view, but we see it as an inevitable company. A company that's going to be around forever and a day.
Sure.
It's still going to be there in 20 years' time, rating debt, etc. So it's a long-term position or core position within our portfolio.
Makes a lot of sense. Another company that we assume might be present for quite a while, except if it does get disrupted by mobile payments and of course new technologies in order to facilitate transactions, is Visa. Whenever we think about them, we think of their competitors MasterCard, and of course that they produce these banking cards, Byron. But does it still hold water? Is it a strong investment case despite the new movements taking place in the mobile payment space?
Well, the irony is, and it seems, we obviously have been following the stock very closely for 8 to 9 years. Every time there's a new innovation in the sector, they still want to use Visa switching technologies.
The background systems.
The back-end systems that Visa and MasterCard have set up are just superior to what anyone else can make, and no one's really interested in taking on that business because they've just built such a strong moat around that system. So Apple Pay, PayPal, all these big payment companies, Stripe, those guys as well, all back in using the likes of Visa. And then you've got the way the world's going. So 80% of transactions still take place in cash. So there's still huge room for growth. But then you've got, you know, the Ubers, the Amazons, the Airbnbs. They all lock in your credit card, and you're paying everything literally by, you know, one-time PIN, couple of clicks, and it's all going through a Visa system. So we just think that the world is going to continue in that direction, especially when you consider that governments love it because it's traceable.
Yes.
You know, cash is obviously, you know, a lot of bad business is done using cash or Bitcoin. And, you know, we often said, you know, during the big coin bubble and boom and everyone was talking about, rather just invest in Visa.
Yeah.
You know, they are simplifying transactions, making it easier, making it quicker, but using the currencies that we're all very used to.
Makes a lot
So
of
we
sense.
think it's a fantastic business. I mean, it's not cheap. It trades at like 40 times earnings, but
Oof.
it has incredible margins, and it has traded at 40 times earnings when it was trading at $30 a share. Now it's over $200 a share.
Sure. So just when you think that they're not well entrenched in the market, well, they've obviously got themselves well established within the background systems. So much to consider on the show today. Gentlemen, thank you so much for your time and, of course, giving us some insight into some stocks that we can pursue as we try to expand on our offshore exposure. A big thank you to Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Byron Lotter, Portfolio Manager at Vestact. And, of course, thank you for tuning in and joining us this evening. Of course, we look forward to getting all your questions, suggestions and comments. So tweet us at CNBC Africa, use the hashtag Portfolio Watch, or feel free to send an email to portfoliowatch@abn360.com. Until next week, have a wonderful evening.